Welcome to our financial accounting class. This is financial accounting for non-managers. So we're going to start with briefly the qualitative part of financial accounting. To start with, financial accounting is interested in understanding who are the key stakeholders to this information. So there are groups of people who might use accounting information, who may include from both internal and external users. So if I may ask, which internal users do we know of financial accounting information, and who are the external users of financial accounting information? Quickly, you can give me 5 from each of them. Number 1. Okay, in the interest of time, we have the following users of financial accounting information. So we have the people we call the managers. So these managers need to have an understanding of financial accounting information because they are the ones who run the day-to-day running of the business. They need to give an account of how efficiently they're utilizing the resources in an organization. So from the accountants, from the manager's perspective, we even come up with what we call efficiency ratios under ratio analysis. So you must also understand that the first lesson is very cardinal, though theoretical, because it marries with the ratio for financial statement analysis. So we have other custodians of financial accounting information like employees. These ones are keen to understanding of accounting information because they want to ascertain the ability of the firms paying them their salaries. So they need to have some basic understanding, and they'd be interested in looking at the financial statements and seeing the payability of this institution I'm working for. We also have creditors. Creditors are people who would loan the company money. They would borrow the company money. They would lend the company money. So a creditor is simply a person who lends us money. So they would be interested in looking at your financial statements to seeing your liquidity. So whenever we're dealing with ability to paying debt, we talk about liquidity. So they are interested in knowing how liquid are you. So to that effect, they are interested in what are called liquidity ratios. So liquidity ratios are to do with how the firm is able to meet their short-term or immediate debt obligations. So the other key custodians or users of financial accounting information are the federal government for tax purposes. So government will want to see your statements so that they could ascertain whether you are tax compliant or not. We also have prospective investors who want to understand the performance of a particular business, and they would also need some basic accounting information that would be used. We also have who else is keen to financial accounting information? Who have we left out? We talked about employees, we talked about managers, we talked about shareholders. These are the owners of the business. A shareholder is the owner of the business who can come in terms of an ordinary shareholder or an equity holder. It can also come in terms of a preferred stockholder or preference shareholder. So this owner of the business buys ownership of the business through what are called shares. So a share is simply an allotment of ownership in a business that an individual would buy. So the return on the share is called a dividend. The return on a share is called a dividend. So we have two kinds of owners: preferred stock owner or the preference shareholder. This one is always given the preference when it comes to being given dividends. So this individual will be given a fixed amount of what? Dividend every time a dividend is declared, whereas an ordinary shareholder is the original owner of the business who has voting rights is given the residue of the remaining dividends. So why is the shareholder interested or should know basic information about accounting? Because for him to be able to declare whether they are rightly being given their dividends, they need to have that kind of information. So this is what we're talking about. So managers, I've already spoken to say these two people live in antagonism. The manager wants to maximize what? Profit and retain them into the business and plow back, because he knows once I borrow, I'll borrow at an interest. Whereas the shareholder wants to maximize his capital gain by having dividends declared to him at a very high rate. So these two have to balance up. Of course, the managers are accountable to the owners of the businesses who are their shareholders, who have what is called a board of directors. So in business or accounting, there are some key terms that you need to understand. We're going to talk about the vocabulary of about 20 terms. So I'm teaching you like babies because I'm assuming you are learning this for the first time. So we're going to look at accounting terms that will be useful for our class so that we are at par with accounting terms. Okay, so basically this is about the users of financial accounting information. Now this financial accounting information has some characteristics that you need to really know. The accounting information must be relevant. Okay, must be relevant in the sense that it must identify the needs of the users. It must be reliable, meaning whoever is using it must ensure that the accounts that are being presented before them are audited. It must be comparable. Comparability is mainly about using accounting standards that from time to time can be could be consistent. So this is another characteristic of accounting information, comparability. The accounting information also must be what? Understandable. So not all users have a financial background, but it must to some extent be able to be understood by whoever is using it. Must be able to meet the knowledge basic level of an individual who would at some point read and understand. So these are the characteristics of financial accounting information. Okay. So the other characteristic that accounting information must have is it must be complete. So usually completeness may be difficult to achieve because of the volumes of work, but there should be a degree of completeness, because once information is missing, you may have loopholes. It must be objective. This means that though financial statements are prepared by management and are kind of biased and are audited by external, must be objective to meet the objectives of the firm, and must be objective for effectiveness of an audit. It must also be timely. That's why whenever you're preparing books like a trading account, it has a time there for the year ending 2002. Balance sheet at 2002, 31st December. So due to the volume of work, financial statements may not be provided at the time they're required. So accounts must be prepared quickly based on the estimates of time for them to be reliable. Okay, so this is a summary of what we've talked about. The users of financial accounting information, the management, who are the managers, the shareholders, the employees, the lenders, the public, financial analysts, the government, and the creditors. So now we want to also understand a few books that are used in accounts. So in accounting, we have some books that you need to understand. There are books that are called journals. A journal is a day book that is produced for credit transactions. Every day, whenever there's a credit transaction that is done, we use what is called a journal. We have 4 kinds of journals, in fact 5. What we call a sales journal, where all credit transactions are done. We also have what is called purchases journal. So these books of accounting you need to know. I'm just giving you an overview of what we're going to be passed. So books of accounting. Can you tell me what other books you know? What other books do you know in accounting? Journals. We have 5 types of journals. Number 1, we have what is called a sales journal. A sales journal is simply a book of accounting where all credits, sales are recorded. We have a purchases journal where all credit purchases are recorded. We have a purchases returns journal where all purchases that are brought back into a business are recorded. We have a sales returns journal where all sales that are retained are recorded. Question: why would goods that were purchased be retained and sales that were made be retained? Simple. Wrong consignment, expired, or perhaps they were wrongly delivered. So whenever goods that are sold are brought back, we call that sales returns. Whenever what we bought it's taken back, we call that purchases returns. So a journal is called a day book because it happens on a daily basis. So whenever books are retained or goods are retained, we produce what we call a debit note or a credit note. So for things that are damaged, expired, for all sales that are retained, the document that we produce is called a debit note for sales that are retained. For purchases that are retained, we will produce what is called a credit note. Credit note. So the other term for returns inwards or purchases returns. Okay, sales returns, they're coming in after we sold, they're coming in, that is returns inwards. Purchases returns are returns outwards. We bought but we're taking back. So this is on the day books. So we also have another important book which is called the cash book. The cash book is a book of prime entry where all cash transactions are recorded. In a cash book, we have 2 columns for the bank and a cash account. The document that is produced for all cash transactions is called a receipt. The document for credit transactions that are produced is called an invoice. We deal with these every day, so I need us to really understand. So the receipt is used for all cash transactions, whereas an invoice is used for all credit transactions. So whenever goods are paid for promptly, there's a discount that is given, which is called a cash discount. There are 2 types of discounts. Discount allowed is when we are giving the discount ourselves. The discount received is when we are receiving a discount for buying. So one of it is a gain and one of it is an expense. So we'll discuss the other terminologies. I'm assuming all of you are learning this for the first time, so I'm trying to be as basic as possible so that my evening class may not be tedious. Sorry, allow me to just extend I know it's 14 hours. I'll extend for 2 minutes or 3 minutes. So the cash book has what we call the bank and the cash account. All bank transactions are recorded in the bank account, and all cash transactions are recorded in a cash account. So all these two are assets that we own as a business. So we're looking at the books. There's also another key book which is called a ledger. A ledger is simply a book of accounts. Even the cash and bank accounts are found in this ledger. Simply a book of accounts. We have a purchases ledger, sales ledger, we have debtors ledger, creditors ledger. When we compile all these, instead of writing an individual personal account, we'll group them into what is called what? A ledger. So this ledger has purchases ledger, where we put all purchases in this ledger account. We also have the sales ledger. We also have a general ledger. Okay. So in this ledger, it will have balances that will be posted to a book called a trial balance. A trial balance is simply a list of balances which shows whether we have a credit or a debit balance. So a trial balance is simply a list of what? Of balances. So we're going to learn how to do the balancing later on, but whenever we balance them, either on the credit or on the debit side, we call that what? We call that a trial balance. Then we go to another key term, which is an asset and liability. So in the trial balance, we're going to bring in 3 or 4 key terms. There's what we call the debit side, there's what we call the credit side. So whatever we're receiving, the trial balance works on what is called the duality concept. This duality concept assumes that everything that comes in, we do what? We debit. So whatever we own, for instance, all assets, they always have a debit balance. So we have assets here. The opposite of an asset is a what? A liability. So anything going out or a cost to the firm is called a liability. So liability always have a credit balance. We have 2 types of assets and 2 types of liabilities. We have what we call current assets and non-current assets. In the olden times, we used to call them fixed assets and current assets. Under liabilities, we have what we call the current liabilities and the non-current liabilities. So we also have another part of the trial balance which is debited. These are expenses. Expenses always have a debit balance, whereas the opposite for expenses is a gain. The gains always have a what? Credit balance. So there's much that I need to talk about in the introductory class, but for now I'll end here.